Good morning. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. And in the wake of the Great Recession, the disappointing recovery, I think we're confronted with several big unanswered questions about the economy. Why has productivity growth been so slow? Why isn't business investing more? Why has it been so hard for central banks to get inflation up to their 2% target? I mean, when I started covering central banks, getting inflation up was not their major challenge. How exactly does quantitative easing, the trillions of dollars that central banks spend on buying long-term bonds, work? Or does it work at all? How big a debt can a government incur before it really runs into trouble? So today, we're not going to address any of those questions, but we are going to address another important one, which is, where will interest rates be when the economy finally returns to normal, and why does that matter? Now, I suspect to many American consumers and business people, that doesn't sound like a very important question. They're probably more worried about what's going to happen to interest rates in December and what's going to happen to the interest rates in the near term on their savings, on their auto loans, on their variable rate mortgages. But as we'll hear today, this question, what is the long-term equilibrium interest rate, is really a very important one, not only to the Fed, but to savers, investors, and businesses as well. We'll hear today that there's been a marked decline in this measure over time, and we'll ask some questions about that. Is this a symptom of some economic malaise, of secular stagnation, or does it reflect the aging demographics of economies, particularly in Europe and Asia, that have produced a glut of savings that is putting interest rates down? Is this a long-lasting trend or a temporary one that'll dissipate as we finally recover from the Great Recession? Does this mean that the Fed and other central banks are going to repeatedly find themselves with interest rates at zero, concluding that that's not low enough? Does this mean that governments can safely borrow more than we thought they could? What does it say about the returns that pension funds can expect over the coming decades? Now, answering these questions, which is hard, does require a look at history. It's hard to know where you're going unless you know where you've been. And it also requires some economic models, because the long-term equilibrium interest rate, sometimes called the natural rate, cannot be observed directly. There's a wonderful quote in the Williams and Laubach paper from an economist named John Henry Williams. Is he related to you? No. John Henry Williams, who was a Welsh economist, educated in the U.S., and he said in 1931, quote, "The natural rate is an abstraction. Like faith, it is seen by its works. One can only say that if the bank policy succeeds in stabilizing prices, the bank rate must have been brought in line with the natural rate. But if it does not, it must not have been." So that's why you can't understand what the Fed is doing right now. Today's event is sponsored not only by the Hutchins Center, but by the Initiative on Global Markets at the University of Chicago's Booth School of Business, which originally commissioned one of the papers we'll hear today. This joint venture is a first for the Hutchins Center, and we look forward to doing more of this. In fact, we've already scheduled our second one in Chicago for November 10th, when we'll discuss a book we're putting out called The $13 Trillion Question, a book that looks at not how much the Treasury should borrow, but how it borrows. And like this event, that event will be webcast, so if you can't make it to Chicago, you can still participate. This morning we're going to begin with a paper that has 4 co-authors, which is a miracle in and of itself. 2 from academia, Jim Hamilton of UC San Diego and Ken West of the University of Wisconsin, and 2 from Wall Street, Jan Hatzius of Goldman Sachs and Ethan Harris of Bank of America Merrill Lynch. They're going to talk about the equilibrium real funds rate, past, present, and future. And then Anna Cieslak of the Fuqua School of Business will respond, and my colleague Louise Shaner will come up and have a brief conversation with them. And if we have time, we'll take some questions from the audience. After that, we're going to hear from John Williams, president of the San Francisco Fed, on a paper he and Thomas Laubach, director of monetary affairs at the Federal Reserve Board, have done updating earlier work. And we're very pleased that Maurice Obstfeld, now the chief economist of the IMF, will respond to that. I'll moderate that discussion. And finally, we'll turn to the implications of all this in a panel with some of the authors and respondents, and with Anil Kashyap, my friend from the Booth School. If anybody's moved to tweet about this, we have a hashtag equilibrium. I can only imagine the other things that will show up under that hashtag. Might be more interesting. With that, let me invite Ken West to come up and present the first paper.
Well, thanks, David, and thanks, everybody, for coming. As David said, this is a 4-author paper. My colleagues, my co-authors, are here in the audience, and I hope they will join me in following up on any comments that the discussant has and any questions you have in the audience. All right, David framed the question well. This is topic is what is going to be the long-run safe real interest rate. Conventional wisdom about the value of this unobservable variable is that it's at a value of 2%. In terms of presenting that conventional wisdom, I'm going to turn to the members of the FOMC. So one of the innovations that Ben Bernanke made was periodically surveys the members of the FOMC and asked them their view on the evolution of some important economic variables. He asked them, the FOMC members are asked to weigh in on what's going to happen this year, next several years, and in the longer run. Among the variables they're asked about is the nominal federal funds rate and inflation. Back when this survey started in January 2012, the view was that, of the members of the FOMC, was that the Fed funds rate, once we get out of the soup of the Great Recession, would rise back up to 4%. Inflation would hit the target of 2%. The implied longer run value of the safe real rate is therefore 2%. So the variable we're interested in, the variable we're discussing, is this longer run safe real rate. Conventional wisdom at one time had it that this value is 2%. Well, that's conventional wisdom, but there's a general consensus that that 2% figure is too high, and we are going to share this consensus. We're not going to contradict this consensus. This consensus that it's too high we see in the blogosphere, punditry, and financial markets, and in the FOMC itself. Start with the blogosphere. There's a quote there from Larry Summers, who, of course, is a believer that we may be in for an extended period of really crummy growth and secular stagnation. If so, that's going to lead the Fed to set their nominal interest rate for a long period of time down to 0, he says. Not that 4% figure we saw before, but 0. Set that nominal interest rate at 0, you get inflation at that 2% or any reasonable figure. You're not going to end up with a 2% long-run safe real rate. You're going to end up with something negative. You're going to have a 0 nominal interest rate minus inflation. So Summers says that conventional wisdom is wildly wrong. Financial markets tend to say it's modestly long. If you look at what's happening in tips in 5 to 10 years out, depending on where you look, you're going to get a figure not of 2%, but 0.8, 0.9, 0.7%, something less than 1. And finally, the FOMC itself has rethought where we're going to end up. So the most recent survey, the FOMC, and the summary of economic projections happened back in September. Members of the FOMC still think they're going to hit their 2% target, but now they think once we get out of the soup in some longer run period, nominal rates are going to rise to 3.5 and the implied real rate is going to be 1.5. All right, so everyone thinks this longer run rate is going to fall. We do as well. Our goals here in this paper are in the end to think about what this safe rate's going to be in the long run. Along the way, we're going to talk about how it's behaved in the past. Help us get an idea of how it's going to behave in the future. So our conclusions here, number one is, well, we don't have this great quote that you know, you have to have faith in terms of what you're finding, but like some religious ideas, maybe they're hard to convey, hard to pin down. One reason this long-run safe real rate, this equilibrium rate, is hard to pin down is it's highly variable. If there once was a consensus that 2% was a reliable figure, that consensus is ill-advised. At no point do we think this is a constant or near constant of nature. It moves around all the time. Finally, it has many determinants. The slide in particular notes that trend growth doesn't seem to be a particularly important determinant, and we make that point because there is a literature, as I'll discuss later, that turns to trend output growth as a particularly important determinant of the long-run safe real rate. What is our bottom line in terms of what the safe rate is going to be in the longer run once we get out of the soup of the Great Recession? Our view is, we have a wide range here. Our view is it's hard to pin down, maybe as low as 0, a little above 0, maybe as high as 2. Now that range 0 to 2 is not so much a formal confidence interval as it is numbers we get from looking at this question in a couple of different ways. Partly we look at this in an informal, what we call narrative discussion. That discussion looks to and tends to find mean reversion in the safe real rate and kind of thinks, well, maybe it used to be 2. Arguably, it could get back up to 2. That's part of our discussion. Then we look at it in a completely different way, using formal time series econometrics, using that vector autocorrection model that's referenced on the overhead, and that kind of puts us to the lower end of our 0 to 2 range. All right, that's our bottom line, 0 to 2. We also put to work this notion that the equilibrium rate is hard to pin down and ask what that implies for monetary policy. And we conclude that that suggests the Fed should delay normalization, should hold off on the inevitable raising of interest rates. Okay, a bit of overview on methodology. I'm going to have a hard time limiting myself to a single adjective to put in front of real rate. Sometimes I'll say steady state real rate, sometimes I'll say long run real rate, sometimes I'll say equilibrium real rate, sometimes natural rate. So my apologies. In any case, whatever word I'm using, we are thinking, as did the FOMC in that summary of economic projections, where are we going to be once we get out of the soup? What is the longer run value? What is our forecast, 5 or 10 or 12 years from now, or that 5 or 10 or 12 is something that, is uncertain. For what it's worth, in our one set of estimates, that 5 or 10 or 12 we pinned down as 7 years from now. For my fellow economists, let me say that our analysis is reduced form. So the professional economists in the room will when they hear the adjective equilibrium rate, they may think about output gaps and Constance and Taylor rules and other such things. There's none of that here. We're really looking at correlations and reduced form stuff. And consistent with that, when we try to get a measure of the equilibrium rate, we're not doing anything fancy. We're just taking our data. We're saying the equilibrium rate is a steady state rate. So we take our data and we move through our data sample, taking rolling averages. We're going to be talking about the U.S. Occasionally, you'll see reference to international or cross-country data. When you do, that's really solely to inform us about the U.S. Okay, that's the prologue. I'm going to skip over a couple of graphs I got here, and let's get to the meat of the analysis. There's 4 different things I want to talk about before I get to the conclusion. First part of it there is my comment that there's a literature that looks to trend or steady-state output growth as a primary determinant of the long-run real rate. We think that's ill-advised. That's the Roman numeral 2. Second part of it, I'm going to talk about, in a pretty informal sense, what's been going on in real rates recently, and that's the discussion that's going to emphasize there's many, many factors determining real rates, and it looks like there's some mean reversion going on, which suggests an upper end of the 0 to 2% range seems reasonable. Then I'm going to turn to formal time series analysis, the vector autocorrection, and that's going to be the part of our discussion that will lead to the lower end of our 0 to 2% range. And finally, I'll talk about the monetary policy implications. All right, trend output growth and the long-run real rate. There is a large literature that ties the steady-state real rate to steady-state output growth. In particular, the baseline model used by both academic economists and in the policy world has in the short run a proportionality between expected growth in spending and the real rate, positive proportionality. If that happens at each month or each quarter, then you average over time to get a steady state, you're going to expect proportionality as well. So theoretically, that's central part to our economic models, and there's an empirical literature, in particular a paper by Laubach and Williams, who you'll be hearing about later, that argues empirically you get good mileage by focusing on the relationship between trend output growth and by looking at trend output growth to tell us about the long run real rate. All right, we're going to do something really simple-minded here. We're just going to look at various rolling averages of GDP growth and of real rates in the U.S. and abroad and ask whether there really seems to be a reliable relationship between the two. And we're going to conclude no. So the paper, which I recommend to you, it's on the website here, has a bazillion different graphs and tables and numbers in it. And let me just illustrate the basic idea with one graph looking at post-war U.S. in which our averaging occurs peak to peak in post-war U.S. business cycles. The graph here on the horizontal axis is the real rate, on the vertical axis is GDP growth. Each of those dots is an average over a business cycle from peak to peak. So if you take this 1993 figure, for example, the previous peak was 1981-3. That was 9 years or 36 quarters before. You average GDP growth over those 36 quarters and you get a figure of roughly 3. Average the real rate over those 36 quarters and get an average of roughly 5. And the other dots there are similarly computed. Now, this literature says there's a proportionality between steady-state output growth and steady-state real rates with a positive factor of proportionality. You look at that graph and ask yourself, are those two series there positively related? Well, your eye wants to tell you the answer is no, and what your eye is telling you is right. These don't even line up in terms of sign. Let me get rid of that line. Your eyes also tell you that if you drop just a single point, the 1981-3 that's in the lower right-hand corner, the sign will change. And what your eyes tell you are correct, the sign will change. Another way of saying this is there's a big standard error in the relationship between steady-state output growth and steady-state real rates. It's not going to tell you anything particularly sharp. Well, it's not steady-state output growth. What is it? Let me start to transit to our narrative discussion here, and also finish up on the noisiness of the output growth real rate relationship by circling 3 of the dots there. So all 3 of those dots are for business cycles in which growth averaged roughly 3%. And you see that in one of those cycles, the one ending in 1981, the real rate was a little less than 1%. In one of them, it was 3%, and one of it was 5%. Remember, our job, our task here is to think 3, 5, 10, 12 years from now, what's the real rate going to be? Even if we were able to nail output growth over that period, clearly from this picture, that's not going to tell us much about the real rate. Output growth is 3% over the time horizon we're talking about. Sometimes it's been associated with real rates of less than 1%, sometimes 3%, sometimes 5%. You got to look to other things. What other things could you look to? Well, our narrative discussion looks to a slew of things. Let me start to introduce that by just noting this 1993 cycle followed the high inflation of the 80s. In terms of following the high inflation of the 80s, it's our view that there was considerable fear about a tail risk of inflation taking off again, and investors demanded a high premium, a high real rate. Can't think about real rates over that decade in the 1980s without thinking about trends in inflation, for example. All right, some numbers there. Again, to summarize relationship between trend output growth and trend real rates is really noisy. We think it would be ill-advised to focus on that. Narrative discussion of real rates is next. I began it there with my brief discussion of the 1990s. That's about as specific as I'll get for the narrative discussion. Let me invite you to look at the paper and see the list of factors that we have adduced as substantially affecting the equilibrium rate at one point or another in U.S. history. Any one of those can and has generated a slew of papers. We, I think, successfully managed to bring all of those into this discussion by keeping our discussion kind of informal, using a narrative rather than formal discussion. The bottom line of this is that we could easily, or perhaps support we could certainly support a wide range of equilibrium rates, perhaps up to as high as 2%. In connection with that, let me just touch on 2 points. One has to do with real rates in the last couple of complete cycles, and the second on secular stagnation. So in terms of the first point, we're in the soup. Nominal rates are 0. Real rates are negative. Are we going to be stuck there forever? Where there's been previous times when rates have been low for an extended period, and we did seem to mean revert to more or less traditional levels. So take the second bullet point there. During the 2000s, we were stuck below 0.3% for nearly 4 years, but the real rate ultimately rose to 3%. So just because we're here now doesn't mean we're going to be here forever. Well, we may be here forever if we think we're in a world of secular stagnation. We do not. Instead, we think the current crisis is the current situation, is more consistent with the aftermath of a financial crisis, compounded by some special factors, including fiscal tightening, plus some brinksmanship, which we just managed to avoid repeating. So equilibrium rate is affected by a lot of factors. There is some evidence of mean reversion that can push us to the upper end of our 2% range. Now we're going to take a completely different tack. The narrative discussion looked to a lot of factors, was kind of informal, appealed to mean reversion. Now we're going to be really narrow, just look at interest rates, be a little more formal. In particular, we're going to develop a model for the short-term, for the interest rate. It's going to be a bivariate model that will have point-in-time observations on the U.S. safe rate using annual data. And it's also going to have the global steady-state rate, worldwide steady-state rate. We're going to get the worldwide steady-state rate by computing the steady-state rate in each of 17 countries in our sample. We get the steady-state rate for each of the 17 countries in our sample. Then in each year, we order those from high to low, and we pick out the median value, and that is our global steady-state rate. Here's a picture. The black line is the U.S. real rate annual. The blue line is this global world steady state rate. We've hit what's called a vector error correction model. This is a model that is intended to work with time series that are very trendy. I would ask you to look at the black line there, the U.S. rate. It has been noted in connection with secular stagnation that that rate has been falling pretty steadily for 30 years. That's the fall you see from the late 70s to the present. If you can't read the axis in the back of the room, it starts in 1850 and goes to 2014. So this falling period I mentioned is. You know that prior to that 30-year secular fall, there was roughly a 30-year secular rise from the late 40s to the late 70s. And prior to that, there is roughly a 30-year secular fall from around 1919, 1920 to the late 1940s. So that's a series that shows long, slow movements. That's a series that a statistician or econometrician would say is well modeled with something called the unit roots. That picture also suggests that when the black line gets too far away from the blue line, it gets sucked back. That's called error correction in time series jargon. Look at that picture. A model suggests itself. We estimate it. Top of the slide are specific numbers for any of you time series nerds in the audience. The bullet points at the bottom give the bottom line, which is when the U.S. rate is below the world steady state rate, it tends to get sucked back at a rate of about 40 basis points for every percentage point it's below the world rate. However, there's a lot of noise in that series, a lot of noise in that series. And in particular, standard deviation, the residual is 260 basis points, which suggests year to year, this 40 basis points of being sucked back is probably going to be swamped by noise and might be hard to detect. Let's put that together to give a forecast. So the black line is our forecast. The first data point, 2014, is data. The rest is a forecast. We forecast both the global rate, steady state rate, which is in blue, and the U.S. rate, which is in black. Takes roughly 7 years to get to steady state, 2021, 2022. It asymptotes there at 0.4%. So that's our version of this FOMC Summary of Economic Projections question. What is the longer run value of the real rate? This model says 0.4% to be achieved in roughly 7 or 8 years with a big confidence interval. And this accounts for the lower end of our 0 to 2% range. Finally, I've been talking about point estimates. That previous graph had huge confidence intervals in the dashed lines. Let's talk about the monetary policy implications of those huge confidence intervals of a lot of uncertainty. So there is a literature that notes that when a monetary policymaker is uncertain about what's going to happen, it pays to be cautious, to not do much. In the particular context of maybe you're uncertain about the equilibrium rate, about the long-run safe rate, there's the paper by Orphanides and Williams that argues that this general prescription, this general presumption that when you're uncertain you should move slowly, it applies in particular to when you're uncertain about the equilibrium rate. So what we do is ask whether this presumption has empirical bite when you use a serious and realistic model of the U.S. economy. And in particular, we take the FERBUS model, which is the official staff model of the Fed, and we ask the question, suppose you are uncertain about the equilibrium rate and you use the FERBUS model to think about what to do, how does that affect what a monetary policymaker does? How does that affect? Does it have a big effect? Does it have a small effect? So we're going to, in terms of the jargon that's going to appear on the picture, we think about, do you just want to adjust smoothly, or would you like to move cautiously and put inertia into the rule? And quantitatively, we conclude you certainly do want to put inertia into the rule. So the black line there is a smooth adjustment of the rate that would be appropriate if there was no uncertainty about the equilibrium rate. The green line is what comes from uncertainty. You'll note that you delay normalization, that's at the to your left, far left of the picture there. The green line stays at 0 for longer and compensate a bit by raising more steeply in the end. Now that is a reason to delay normalization. At least in my view, that's not the number one reason to delay normalization. Here's a bunch of other reasons. I have to say, we first presented this paper in February. The slide is unchanged from February, unchanged. So there's still a bunch of reasons to delay normalization. The labor market, inflation, the risk to global growth. There you have it. Thank you.
Okay, it's a pleasure to be here to discuss this paper. Ken did a fantastic job talking about the key results in the paper. The question couldn't be more timely. What is the value, the level of the equilibrium real rate or natural rate? And they estimate it to be between 0 and 2%. They find little support for secular stagnation. View that the natural rate is going to stay low for an extended period of time because of weak growth. So I will talk about 3 comments. I should say that I am in broad agreement with the conclusions of this paper, and I will just provide some additional evidence on the results that the authors reach. I will talk about the distinctive properties of real rate implied by the models that we estimate as econometricians versus what private sector thinks and what policymakers think in their forecasts. I'll also talk about the amount of uncertainty and the level of long-run growth and whether or not we should actually give up completely or on there being a link between growth and the interest rates, okay? And through the talk, I'm going to highlight the perspective of an agent who forms their expectations in real time, okay? Let's look at a bunch of estimates that are out there. These are recent estimates of the natural rate. So 3 groups of estimates. The first one are model-based by econometrician. Second one, policymakers, including FOMC members and CBOE. And finally, private sector forecasts of averages of inflation and nominal short-term interest rates, which give rise to something which should be in the ballpark of equilibrium real rate, okay? Vastly different, and what you can see immediately is that model-based estimate would suggest that the real rate is negative, equilibrium real rate is negative, and so very negative in a way, while the real-time forecasters would say, well, it's in the range between probably 0 and 1.7%, okay? The estimates based on models differ not only in the current level, but also in the time series dynamics, and vastly so. Okay, so here are 3 representative estimates, including the paper that I believe John is going to present, the red line, and the blue line shows you an estimate of the equilibrium real rate from Chicago Fed, and finally, that gray line is a recent estimate by Cordia. You can see vastly different estimates, and it's true that assumptions and horizons over which those equilibrium rates are computed differ, but within each particular model, which you can't see, confidence intervals, there is a confidence interval around the blue line, which you probably cannot see, but what that confidence interval tells you is that, in fact, those 2 lines just don't overlap, okay? The red and the blue line don't overlap. So vastly divergent views of where the equilibrium real rate is today and also how it evolves over time, in particular how much time variation there is in the rate. Now let's look at the second set of estimates, which is survey-based estimates. These are real-time estimates that are formed by professional forecasters. Three lines, two solid lines, are showing you the equilibrium rate that is midterm of the horizon of about 5 years, and probably the closest to the notion of the equilibrium real rate is the dotted line, which is a really long-term forecast of that rate. It does go down, but it doesn't go down as much as our models would suggest, okay? So my data ends in 2013, but the number that the data survey forecast suggests is about 1.5, okay? At the same time, when you look at the confidence intervals implied by the range of survey forecasts in the long run, probably you could reject that people think the real rate is below 0, okay? So very different views of the world between real-time forecasters and econometricians. Now, I believe it is key to really understand how agents form expectations in real time for the simple reason that those expectations get impounded into interest rates and are a basis for decision-making, economic decisions, and then financing costs for households and firms. So I spent some time thinking about how people form expectations about the short rate. And this chart is showing you term structures of expectations by professional forecasters. This is the forecast of effective Fed funds rate from today 5 quarters out. What you can see is clear systematic pattern where agents expect the Fed to tighten more than it turns out to tighten ex post, okay? What does that mean? It means that forecast errors are going to be large ex post. This chart is showing forecast errors that agents make at a 1-year horizon. It can easily reach minus 400 basis points. And you can clearly see a systematic pattern in those forecast errors, okay? Now, you might not believe survey forecasts, that's fine. If you look at asset prices that kind of load on the same object, like a federal funds futures, they would give you a very similar picture, okay? Now, in my work, I have argued that post-85, that forecast error has been co-moving very strongly with errors that people make about unemployment and output gap, and much less about inflation, okay? So this suggests that what this forecast error really represents is the forecast error about the real rate at 1-year horizon. Now, the systematic nature of the error is problematic when you want to do econometrics in full sample, okay? And what this chart is showing you is 2 types of real rate estimates. Admittedly, that's a short-term real rate. But the red line is showing you the survey forecaster, what they think real rate is going to be. And the black line is showing you what an econometrician thinks, having access to the entire time series of data. The econometrician is not using any revised data, but I assume that they have access to the full sample and estimate parameters on the full sample, which most of our models do. And what seems to be the case is that econometrician thinks that the real rate is going to be actually lower than the real-time forecaster. So that dynamics is showing you the wedge in expectations between the econometrician and the real-time forecaster, and obviously this wedge is very, very significant, okay? So it can reach up to minus 200 basis points in recessions, okay? So it seems that econometrician has a more pessimistic view about the real rate than a real-time agent. It seems important for us to decide which notion of the real rate we should focus on, whether it's the real-time forecast of the agent who makes decision based on those forecasts, or we should believe more in our econometric estimates, okay? Now, going to my second comment about there being uncertainty and decline in the level of growth, okay, which seems to be at the heart of many models that we use. This chart is showing the term structure of forecasts of real GDP growth from surveys. And the dotted line is 1 quarter ahead forecast, the red line is 1 year ahead forecast. Now, superimposed is the really long-term forecast of growth. Looking at that chart, I see little evidence that we are in a period of really unusually low growth expectations. And again, the blue line is showing us 10-year expected growth range, okay, which seems to go together with the intuition in the paper, but against the secular stagnation view. We are sort of back to normal, okay, above 2%. Now, maybe the level of growth expectations hasn't changed, but the uncertainty has increased, okay? This could still push interest rate downward. So I can cast some light on that question, again, using the physical distributions that agents have in mind when thinking about the distribution of growth expectations. And you see here two plots. One is before crisis and after crisis. And these are the expectations or the probabilities reported by real-time forecasters that growth is going to be in a particular range, okay? It is true that on the right-hand side you see, yes, in the short run, growth expectations declined, but after 1 year we were sort of back to normal. The uncertainty has just increased. What about today? This you can see in the lower graph, okay? In the lower graph, on the left-hand side, you have current distributions as viewed by forecasters. And on the right-hand side, you see 2 decades ago. To me, those two distributions of growth as perceived by agents look really, really similar, okay? So I don't see that either uncertainty about long-term growth is vastly different today than it was a couple of decades ago, or the level of growth, the point estimate, is vastly different, okay? And I think the point makes a very, very important, the paper makes a very important point about the relationship between growth and interest rates, for the reason that in most models, the positive relationship between growth and interest rates is at the core of the analysis, okay? And this problem is very well known. Well, that's the equation that appears in all representative agents models, pretty much, that we look at. And that intertemporal trade-off or smoothing of consumptions that agents make implies higher rate mean higher expected consumption growth, okay? Now, there is vast literature that says that that relationship is awfully difficult to estimate, and the authors confirm that conclusion looking at correlations between growth and real rates. So I think that's a very important takeaway from that paper, that building our models on a relationship that is really difficult to detect empirically may not give us reliable conclusions about where the equilibrium real rate in fact is. Looking at survey forecasts again, very different conclusions about the relationship between growth and real rate, ambiguous results, as the authors seem to find. People think that productivity growth and the real rate seem to be negatively correlated, but GDP growth and real rate are positively correlated. What I would welcome is more analysis that decomposes the growth of real GDP into components, productivity and inputs, okay? And my final comment is whether we should entirely give up on the link or on there being a robust link between real rates or interest rates and growth. And I do think that we have very robust evidence that such link exists, not maybe in the long run, which is difficult to detect, in the shorter run. We know from previous studies that the term spread, the slope of the term structure, is a very robust predictor of growth, okay? Now, conceptually, slope moves of the nominal yield curve can move around for three reasons: expected inflation, term premium, or the real rate, okay? And I've done some work that tells me that about 60-70% of variation in the slope is due to the real rate variation, okay? So what this very well-established relationship between slope and growth captures is an intertemporal trade-off in a relatively short run. In other words, what the slope of the term structure seems to capture is a gap, real rate gap, okay? So deviation from of the short-term real rate from equilibrium rate. And it seems to be really useful to analyze this insight further, because as much as equilibrium rate is important, it is also important to understand where monetary policy stands today in terms of real rate compared to that equilibrium rate. So let me conclude. I broadly agree with the conclusions of this paper, looking at the data that I have analyzed. I do think that it is really important for us to embrace the notion that real-time expectations matter, because they are the basis for decision-making. And those seem to be based between the discrepancies between models and those real-time expectations are just too large to ignore, okay? There are some strong model assumptions that underlie much of our analysis, and I do think that thinking more carefully about how those assumptions translate in estimates is really important, okay? So great paper, very important topic. Thank you.
So I'm going to thank you for a great paper and a great discussion. We just have a few minutes here, and then we'll have more time for discussion later. But first I want to give the authors, either the ones in the audience or you, a chance to respond to Anna's comments.
But they're great comments. I learned from them. I enjoyed them.
Anybody?
Yeah, that was Jim Hamilton. Okay. Jim Hamilton, thanks. I agree with Ken. Those were fantastic comments and great evidence that I think complements quite a bit what we say. One thing I'd emphasize, and I think you were trying to say this too, there's a difference between a 1 year ahead forecast and a 7 year ahead prognosis. I mean, I think we all agree that what happens to GDP in 2016 is going to be related to what the Fed funds rate that the Fed sets. But the question is there this long-run correlation? That's the evidence that we looked for and found a lot less confirmation than we were expecting to.
Okay, I have some questions. Okay, so let me ask you a question. So you give this narrative, which is really interesting, but so do you not have sort of one story for the reason for the secular decline in the real rate that we've seen since the 80s? Or is it really just a bunch of series of different things that have happened along the way?
Bunch of series of different things. We can point to perhaps productivity, demographics, global savings glut, changes in discount factors, many things.
Many things. So
Yes.
There's not like, oh, here's what really is the big story.
Correct.
Do you think that your paper shows that there is no important relationship between the growth rate of the economy and the real rate, or just that it's really hard to prove?
My view, very hard to prove. Very hard to prove. It's got to be a factor. It's got to be a serious factor. However, so many other things are also serious factors that the link is hard to identify, and it would be foolish to rely exclusively or predominantly on that link.
So you give an estimate of the real rate that's sort of relatively low relative to history. If you don't know sort of what causes it, why is it that you've sort of gone lower in the near term?
Well, first, let's review that we have this range from 0 to 2,
Yeah.
and 2 includes the traditional value. And I would say that the 2 has to do with maybe what's happened in recent history we'll return to. The lower end, in terms of the forecast I ended up with, had to do with just looking at rates itself, which is rates are low globally. And if rates are low globally in an integrated capital market, we're going to expect U.S. rates to stay low. The story as to why rates are low globally, we do not supply.
Mm-hmm. So what would you say actually to someone from CBO who actually got into trouble when they sort of changed their productivity growth rate and didn't change their interest rate assumption? When you're trying to do these long-term forecasts, would you say you should still sort of go back to theory and assume there's a relationship, or should they let those sort of become disassociated?
Well, I would quote Chairman Mao and say, let 100 flowers bloom, let 100 schools of thought contend. I think you should not rely on any one approach to think about any important economic question. And I think actually we illustrated that in the paper with 2 wildly different approaches. So if part of the CBO's forecast ties interest rates to productivity, all to the good. If part of it does not, so much the better.
So sort of assume there's something, but maybe discount it a lot because,
Right.
put a little bit of nod to theory, but not 100%.
Right. Yep.
Yeah, Jan?
Jan Hatzius, Goldman Sachs. I mean, I would answer your question also saying that you shouldn't be too confident in the link. And if you think about it in terms of coefficients, if you have a 1 percentage point slowdown in potential growth, for example, I would be reluctant to put all of that, 1 for 1 into a lower equilibrium rate. Maybe half. I think I could sort of see myself doing that. But I wouldn't give up on it. But just basically pass it through only partially into our star.
And so let me ask another question, which Anna mentioned, which is, so when we're looking forward, a lot of the slowdown that we expect in real GDP growth is coming from demographics, from slower labor force growth, and not some from also slower productivity growth, but not all of it. Different models will have different implications about whether or not that slowdown in labor force growth is going to feed through to the equilibrium real rate. Did you think about trying to separate out the 2? And do you have any intuition about whether or not would you be able to see that in the data, or?
Yeah, I'd emphasize the point about it's a world capital market. And I think too much of this discussion looks at U.S. demographics or whatever, but the U.S. rate cannot permanently deviate from the world rate.
Well, but the demographic change is pretty much worldwide, I think. So if you look at many countries are having a slowdown in labor force growth. So I think you would still, in fact, faster than the U.S. on average. So I think that actually might make it even a bigger effect than what you'd see if you restricted it to the United States. So, and does anybody else? Okay, we can turn to some. We have a few minutes for a few questions from the audience. There's one back there.
Thank you, Vito Tanzi, formerly IMF. In the early 80s, there was a lot of discussion about the relationship between interest rate and taxes. Taxes came down dramatically since the 80s. In the 80s, the normal real rate was assumed to be 3%. In your models, many assume that it is 2%, but I saw no reference to taxes in your discussion. Should we ignore taxes? By the way, tax came down dramatically since the 80s.
Wow. So I had that slide with the narrative discussion. It listed, 12 things? Should we have included taxes on that? I have to say, we thought we told a coherent story without reference to taxes, but perhaps there's another bullet point to be added. And you think we're talking about long run, remember? We're not talking about point in time. So your article is talking about a long run effect on the real rate. Yeah, but afterwards. Ethan there could follow.
Ethan Harris. I feel compelled to say something since I'm an author here. I just wanted to reinforce the point about this, why we're skeptical about the idea that the real rate has dropped as much as people think. we have to remember that this story is not new. We had exactly the same story in the last business cycle. You had the so-called new normal, and it's now being recycled again. The other thing I would say is my personal view is that the main reason why rates have been so low in this recovery is because we've had massive post-crisis deleveraging. We've had a global backdrop that's equally troubled. And then on top of that, we've had a combination of aggressive fiscal austerity and not to mention brinkmanship, just to make it a little bit tougher. So, you know, I've always had a lot of sympathy for the Fed and their desperate attempts to get the economy to grow, but I think the headwinds they've faced have been massive. And so, to me, that's the main argument for why, you know, there's kind of an artificial cyclical distortion to the neutral rate, and it's not secular stagnation.
Let me ask you a question about the brinkmanship. We were wondering about it. So you could think of it as affecting both the riskiness of the asset and also, I guess, investment demand. Is you think it's a matter of why is the brinkmanship bringing rates down?
Well, I think of brinkmanship as basically discouraging investment and long-term commitments. So part of the reason for the subnormal capital spending recovery and weak growth and durable goods demand in general. And you could see it in real time. You know, you could see that as we approach the fiscal cliff and some of these other episodes, there did seem to be this kind of holding back in the corporate sector.
Okay. There's a question over here, and can you please, please stand for when you ask questions. So identify yourself and stand right over there. This gentleman, if you stand, you'll help the.
Hello, I'm Peter Doyle. In looking at your long-term series going back to the 1850s and so on, which I believe you used in your modeling looking forward, there's no mention of capital controls either here or abroad, and presumably that greatly affects both the determinants of the real rate here and the connection with the world rate. So, and I also didn't see it on your list of another item missing from your list of bullets. Capital controls.
Fair enough. I will say that we were able to tell a coherent story, certainly statistically, abstracting from capital controls. So that bivariate model with global rates and the U.S. rate, you're right, did not have any special dummies for periods of capital controls. Nonetheless, the data didn't seem to complain about that. Various statistical tests suggested that it fit the data well. But I take your point. I understand your point.
There, Brennan.
Stuart Brown. You showed a negative real rate and suggested there would be a tendency toward the mean of a higher number. But I'm wondering if you studied periods of deflation and what happened in past periods of negative real rate to actually turn that angle around.
Well, sure. So we had previous periods of negative real rates. I mean, that graph went by pretty quickly, most notably in the Depression, and what turned that around was, of course, World War II. We episodically had negative real rates after World War I and in the 1970s. So I would say in all of those cases, what turned it around was that we ultimately grew. And I think I have confidence we'll ultimately grow. But part of the story of why I don't think negative real rates are here to stay. So I don't think any of us endorse the secular stagnation view that growth is gone.
Anna, do you have any comments on any of the questions? I'll give you a chance.
So talking about deflationary periods in the U.S., it seems important to distinguish between the properties of inflation versus deflation. Before World War II and currently, the short episodes of deflation were extremely transitory, while periods of inflation were very, very persistent, okay? So we don't really have data on persistent instances of deflation. And in those transitory episodes of deflation, real rate was positive, as you guys showed.
Great. Well, thank you very much. We'll do more questions later when we get back to the panel, but I think just like to thank our authors and our discussant for a great panel, and thank you very much. And we're going to get our mics off and then introduce John Williams.
Well, it's great to be here, and I thank Anil and David for inviting Thomas and I to give this new paper on natural rate of interest. It's actually great that Ken gave such a great presentation and we had such a good discussion already, because I think we covered a lot of the basic topics and data and issues, and so I can do what I prefer to do in a presentation, talk about my own work. So. Importantly, in very tiny print, it says the views presented here are those of the authors and not necessarily those of anyone else in the Federal Reserve System. So those 20,000 people, I am not suggesting support this. So let me give a summary. And it does relate closely to the paper, earlier paper in Ken's great presentation. So first, when we started this project around 15 years ago, we naturally, having studied time series econometrics and having learned from people like Ken and Jim, all of that, we first started with thinking about this in terms of trend cycle decompositions in univariate sense, looking at filters and time series methods. One of the things we quickly figured out, which I think is mentioned in their paper too, is that there is problems looking at purely univariate measures of real interest rates to try to figure out what's going on in the long run. We have the same concept that Ken talked about. What's the real interest rate going to be in 5 to 7 years? And the problem here is that there are these persistent deviations from stable inflation and potential output during these periods. And so you see these periods of very low interest rates at sometimes high interest rates at other times, which really reflect cyclical or maybe a medium-term inflationary dynamics and not really longer-term view on real interest rates. So what we did is we thought that we really need a system of equations to think about this. You need to think about what's happening with output, what's happening with inflation, what's happening with interest rates. You have to think about what's happening with trend potential output growth. You have to really think about this as a system of equations. And that way you can control for the things that Ken talked about, the fact that inflation's moving up and down, you're deep in the soup in terms of being in recessions and things, and really try to filter out better, separate out cyclical developments in real interest rates from longer-term developments. Now, the key finding we've had, and by the way, we update our estimates every quarter and post them on the San Francisco Fed's website and provide the programs as well, is that since basically 2009, from starting in 2008, 2009, our estimates of the natural rate of interest fell from this roughly 2% consensus view down to essentially 0. And importantly, our estimates show no signs of recovering since then. They're currently around 0 as well, even in 2015 Q2. And this is, as I'm going to talk about, robust to alternative model specifications. And I will give credit to the authors. This morning we were at an early version of earlier presentation of this paper, and that actually, I think, stirred both Thomas and I to think hard about a lot of the questions that they raised in their paper, and how do we think about those in the context of our own approach. We're going to talk very briefly about monetary policy strategies that will need to be designed to cope with if there are persistently low natural rate of interest and high degree of natural rate uncertainty, which is something we also highlight as was discussed earlier. How do you think about that in terms of designing monetary policy strategies that do well even in an environment with very low natural rates and uncertain natural rates? Now, I think it's important to start with the definitions and terms. So we go back to Knut Wicksell in the end of the 19th century. And there's a certain rate of interest on loans which is neutral in respect to commodity prices and tends neither to raise nor to lower them. So really captured in here is already a multivariate or bivariate definition of the natural rate. And I'm going to come back to the John H. Williams quote, which I just think economists should write like poets. And that's such a great quote. How often do you hear the term faith in describing a model? But here we have the, no, thank you, David. That was like one of those Mets fastballs, right? Okay. Here you can see that the natural rate is already defined in terms of inflation. So in terms of thinking about it, you have to have a concept of natural rate that reflects inflation. And again, already from the beginning, a univariate approach isn't going to work for that. Our basic idea is simple. I think it goes to undergraduate Econ 101 or maybe intermediate macro. And our view of the natural rate, which I think is common to a lot of analysis, even if you use a DSG model or a fancy model, is basically there's a notion of potential output. The x-axis is real GDP here. There is a vertical line. I think it's exactly the same line as on this background. And then there's a real interest rate as the y-axis, and there's an intersection between basically potential output or supply and the downward sloping IS curve, or relating demand to real interest rates. And that intersection between output and potential output and gives you the natural rate of interest, or the equilibrium real interest rate. In our paper, we're really focused on this, again, longer term or medium term notion, not the natural rate of interest month by month or quarter by quarter, but again, this 7 years out, I think, is very similar. So you can think about shifts in either any of these curves. Potentially, I think Ken had a dozen. I think we have the same list. We actually did have fiscal policy on our list because of the work Thomas Laubach has made, showing that fiscal policy can have effects on long-term interest rates. And so you can think of more expansionary fiscal policy as shifting out the IS curve in the long run, giving you a higher natural rate. Of course, there's a lot of things that could affect that, as Ken talked about, and I agree, there are a lot. Now, one thing about univariate measures I'll just very briefly mention, given the time, is so here we show a bunch of bandpass filters, Hodrick-Prescott filters, Stock-Watson time series models, take some averages over 5 years. And the point was already, I think, made by Ken in his paper. We talk about it too. That first of all, you do see over decades variation in real interest rates. And if you look over the longer history, they can last for decades. You see periods of very high real interest rates, and obviously today, very low real interest rates. But one of the problems you see here is that during the period where inflation was rising, during the 60s, in the early 70s, real interest rates were really low, and these univariate methods were saying, oh, well, the natural rate must be low. Well, in fact, what was happening was monetary policy was too easy. It was inflationary. Those low real interest rates weren't equilibrium. They were off equilibrium. Similarly, the early 80s, the great disinflation under Paul Volcker, the Fed purposefully raised interest rates above the natural rate to bring inflation down. And last point I'd make, and this is, I think, an important issue, is any kind of time series method that's on a univariate basis is going to look at 7 years of negative real interest rates, is going to assign a lot of that to the trend. I mean, it's just mechanically going to tell you that the trend real interest rate is very, very low today, and in fact, that's what all these estimates show, is roughly minus 1.5%, which is what real interest rates have averaged over 7 years. So this is kind of arguments that tell you you can't stop with a univariate estimate. So I'm not going to read the John H. Williams quote, but it is exactly how we approach this. This is the Laubach-Williams approach, is basically to say, let's come up with a model where if inflation is rising, and we're going to talk about inflation, not prices, but if inflation is rising, it must be the case that the real rate is below the natural rate, and if inflation is falling, the opposite is true. So you're inferring from movements in inflation and output a view on potential output, the output gap, trend output growth, and on the natural rate of interest. It's all inference indirect from the movements of inflation and output onto what the real underlying natural rate must be. Now, here are our main results. So first, let me show you the model equation just for the natural rate of interest, or R star. So on the right, you see that R star equals C, which is a constant which we estimate, times our estimate of trend growth, that in this case, real GDP growth, plus Z. So Z is the special sauce of Laubach and Williams. So this is the thing we should be focused on. This is where I tend to disagree a little bit with the emphasis on the earlier paper, because they really do highlight this C times G star part, which of course we talked about in the paper. It is a key element of our model. Talk more about that. But actually Z is doing the heavy lifting. This is going to be the variable. And what is Z? Z, we're going to assume, is an unobserved random walk. It moves persistently. In Econ Geek, it's an I1 variable, and it's inferred, again, from the data. Z captures, I'm looking at the 12, maybe 13, maybe 14 bullet points that Ken and other participants talk about that are not G star. So it is all the things that we don't observe directly or don't measure very well. Is captured by this exogenous, what we treat as an exogenous variable Z. In the model, we estimate the output gap, the trend growth rate, and again, Z is highly persistent. We're thinking 5 to 10 years window of other influence in R star, but we're not going to actually put data in there. We're just going to let that be an unobserved variable that we're going to try to estimate. Here is our estimates going back to 1980. What's the blue line is called current estimates. That means if we estimate the data through the second quarter of this year, this is what we get for the retrospective view of what the natural rate is. Very consistent with the message that Ken gave, that, and I'll go back a little further. I think typical estimates of the natural rate, this is one of the speakers said this, a typical estimate was about 3% back in the 80s, about 2.5% in the 90s, 2% right on the cusp of the Great Recession. You can see the blue line coming down to about 2, and then with the bars are the recession dates, NBR recession dates, and then you see it plummet from December of 2007 into 2009 down to essentially 0, and has been 0 or slightly negative since. The red dashed line is actually, since we wrote this paper in 2001, we published in 2003, we have been doing real-time estimates throughout much of this, all of the period I'm showing. So these are the estimates you got in 2006, 7, 8, 9. As the data rolled in, we ran the model, we came up with the estimates. What's interesting here is that the red dashed line, the blue line during the period of the Great Recession, the last 7 years, have been basically the same. There's some minor deviations, data gets revised, the model gets re-estimated. But really, there's not some big disconnect between what we're seeing today. And if you had asked me the question in 2010, what's the natural rate of interest in the Laubach-Williams model, I would have said 0, and that's what I'm saying today, at least in this model. And so there's a consistent message here, and you notice there's really no signs outside of quarter-to-quarter movements of this thing moving off 0 yet. So going back to the slide that Ken presented, he said he presented that I think in February, and he hasn't changed the slide. I can do the same here. Our estimates haven't changed either. Let me talk a little bit about other estimates. We talked, I think Anna talked about this. I think it's really useful. I'm going to put a word of caution. So what I'm going to on this at the end. So the first line is the blue chip survey. What's nice about that, I think Anna showed it, Ken may have showed it, it's asked what do you think real interest rates are going to be 5 to 10 years out. So the question really does conform to our view. So you see the estimate in 1990 about 3%, fell to about 2.5, 2.4, and today is roughly 1.2%. So it's a decline since the beginning of the Great Recession of 1.2 percentage points. If you look at TIPS yields, they went from 2.5 down to about 1 or a little less. Again, a decline of 1.5, similar to what the earlier speaker said. So we talk about the Laubach-Williams estimates. They were a little over 3% in 1990, about 2% in 2007. Again, a consistent message, and then fell to essentially 0 today. And that's a decline of 2.3 percentage points since 2007. So as was pointed out, we have the lowest estimates and the biggest declines compared to some of these other estimates. So what's happening in the Laubach-Williams model? Why is it saying that the natural rate of interest is 0? What's in the data? Because it's not a theoretical model. It's basically a reduced form model. So what it's doing is it's looking at the pace of inflation. Inflation fell during the recession, but has been relatively stable around core inflation, around 1.25%, 1.5%. So out of that, it infers that the output gap was very negative, and then has corrected closer towards 0 as the economy recovered. It also is seeing the potential that output growth consistent with this inflation has slowed quite a bit. So the estimates of potential output in the model, the potential output growth rate, have fallen quite a bit since 2007. And so it assigns, because of this relationship between potential output growth and R star, it assigns some of that decline in natural trend growth to R star. And then the final thing it does, and I'm going to just use a very simple example, is that it says, well, over the last 5 years, GDP growth has been about 2.1%. Potential growth in our model is about 2.1% plus or minus. So growth has been basically on trend. The output gap now in our model has been closed for a little bit. It's actually positive right now. I'll come back to that. But basically, with growth at trend, with no signs of upward or downward pressure, major signs of upward or downward pressure on inflation, it's just saying, well, 5 years of this is probably, a lot of this is trend, a lot of this is permanent. It's not all just cyclical phenomena. Now, it's a trend cycle decomposition in a multivariate sense. So what you see here in our last column is that the decline since 2007, about 1 percentage point of that 2.3 percentage point decline is because of the trend growth part. But a slightly bigger part of it is actually because all these other factors that Ken talked about and we talk about in our paper too. Other things that we don't directly observe, but clearly are indicating that there isn't as much monetary stimulus in the system as you would think. Because if R-star were 2, then the real funds rate is minus 1.5, and you have a 3.5 percentage point real rate gap, our model would expect output growth to be much faster. It's not happening, so the model is inferring that there's some significant headwinds, which are partially permanent, that are holding back growth. Now let me talk about robustness, and this is really, I give credit to the authors of the paper we saw this morning for stirring us, I think, to think harder again about alternatives. And so one alternative we looked at, and this gets to Louise's question, so we actually have the answer. Theory doesn't tell you whether you should be looking at GDP growth or per capita GDP growth, or is it demographics or productivity. So we took one cut at that. We just said, let's look at GDP per capita, which is taking the demographics, at least in at least population sense, out. And we re-estimated our model, and that's shown with the red line. The blue line, again, is our standard estimates of the natural rate of interest. The blue and red lines, are within a few tenths of each other. Basically, our model is flexible enough with this, this magical Z variable to basically differences in the data, whether you're doing it one way or the other, don't really affect our natural rates. You're getting the same story. Basically, it's saying it's getting slightly different breakdown between the growth component and the Z component. You get the same answer on the natural rate of interest. We also looked, and again, kind of under duress, because of this criticism about the relationship between R-star and G-star, and also some criticism of our estimates of the output gap, which, there's a lot of uncertainty about that. We took a different estimate of the output gap from work by our colleagues at the board, Charles Fleischman and John Roberts. It's a really sophisticated model, and I said that because John's in the audience. It's a really sophisticated model of try to get at output gap that's much much more, I think, detailed and involved than ours. They get a different estimate of the output gap. I think it's maybe more closer to CBO and other estimates of the output gap, so is viewed by some people as more reasonable. So we plug that in. We also break the relationship between growth and R-star. We just say R-star is some random walk, we're going to estimate it. We actually get, their output gaps are more negative than ours, so we actually get more volatile R-stars, just because that's how the estimation works. But the point is that they also fall very negative, or fall below 0, and follow the same pattern of coming down since 2007. So I think these particular estimates change as you change different specifications, but the basic patterns hold up pretty strongly. So in my last few minutes, I want to talk about the two issues. One is this permanent or not? Now, one of the things that Ken and his co-authors have highlighted in their paper is there seems to be error correction or a mean reversion in real interest rates, and we don't want to say it's permanent. And I hear words like reasonable. I don't remember reasonable being in Jim Hamilton's book or Ken West's papers. Plausible is a word I've heard Jan use. So I'm not sure what is reasonable or plausible. And I don't have a strong prior on that. But I'll give you some other results from other models that did. That imposed a strong prior that this is real rates have mean reversion. We're being held back by temporary headwinds. It's a work by Vasco Curtia, my colleague at San Francisco Fed, using a DSGE model and a recent economic letter, which I think is great analysis. He does the calculation of the short-term natural rate. It's not the long-term, so it moves a lot more over time. Let's not compare numbers here, because the short-term natural rate moves more. But what he shows is it plummets in the recession. So watch the blue line is the current estimates. It goes from being about 2%, which is a long-run estimate, plummets to negative values once the Great Recession happens. But then all these dashed lines show what his model said the natural rate of interest would do, forecasting from his model, because the model imposes a structure that it's mean reverting, estimated mean reverting process of the shocks and the dynamics. And what you see is every vintage, 2008, 2010, 12, and today, every one of them has said, well, the past ranges would have said the natural rate would be back to 0. But his current estimates show that that never happened. Every time his model said it would go back to 2, what happened is data kept coming in confirming that the natural rate is actually very low, and except for a little bit of a movement up, his natural rate estimates is still below -2. Again, his model's forecasting it moves back to 2. That's by assumption. So these DSGE models, other models that impose this structure, they're plausible. I think it's good to have I don't normally quote Chairman Mao, but I think he's right on this, let 1,000 models bloom. But so far, these models have been, I think, giving us a false signal. We also did an alternative version of LW where we actually assumed that Z is an AR1 process. So we basically said, okay, let's stop assuming these are permanent. Let's let them be transitory and re-estimate the model. So now we have a short-term R star, short-run R star, long-run R star. The results we get is that the long-run R star has come down to 0.8 percentage points. So it's not zero. It does assign some of this to short-term temporary factors. You see the short-run R star falling to very negative, like in the DSG models, and it's moved back towards zero. So the short-run R star in this model that doesn't impose the permanence is around zero, similar to our standard model. The long run is closer, is 0.8. Okay, so I got 30 seconds to talk about what does this all mean? And so I think there's two issues that we really should be focused on. And I don't have the answers, but I think the issues are really important. One is R star mismeasurement. If you look in the paper, basically think about this as a Taylor rule. R star is your intercept in your Taylor rule. And if you have the wrong value of R star persistently over time, that's going to show up through the math of these models and the Taylor rule as by a persistent or permanent missing of your inflation target. So what happens is the mistake you're making under standard Taylor rule translates into mistakes in terms of your outcomes. So there's been a lot of research, Athanasios Orphanidis and I and others have studied this and basically said with a lot of uncertainty about natural rate of interest, you really want to move to policy strategies that are more robust to that. We talk about difference rules or other strategies with inertia that avoid that, and Ken mentioned that briefly. I think the second issue is even more important, and that is you may not be convinced that R star is zero. It could be 0.8, it could be 1.5, but if it is significantly below 2%, we do need to think seriously about what does that mean for longer-term monetary policy strategy. So here's a little I-star arithmetic. I-star is the neutral nominal interest rate. It's equal to the R-star plus the inflation target. And if you have a lower R-star, it means you're going to start every recession with a lower nominal interest rate. You have less room to cut rates. Typically, we cut rates 400, 500 basis points in a recession. If you've got an R star of 1, that means you're going to start with only 300 basis points of room to cut, and you're going to hit the zero lower bound a lot more. You can be stuck there more, and the macroeconomic consequences are greater than they were in the past when R star was 2 or 3. There's a lot of issues that we should, I think, can address this. One is, would a large central bank balance sheet that would, according to our analysis, a large central bank balance sheet might boost R star by lowering term premium, return premium in the markets. That can basically shift out the IS curve. You can think about a higher inflation target, as Olivier Blanchard and others have talked about. Again, this is just the arithmetic. If you need more buffer, that's one way to get it. I think there's issues about how easy it is to shift an inflation objective. There's the issue of using negative short-term interest rates, obviously QE, forward guidance, all the tools that we have shown that we can use, and other central banks have shown they can use around the zero lower bound or the effective lower bound. But quite honestly, here's where I think the real answer is that we really need to think seriously about other policies outside of monetary policy to get trend growth, aggregate demand higher so that R star is higher. So this is one of those times where monetary policy really depends critically on fiscal and other policies, not just in the short run, but in the long run. Thank you.
Okay, good morning. It's a pleasure to be here and discuss this paper. It's a very nice paper, and I really like the structural approach the authors take, and I'll talk a little bit more about it beyond what John has said. it's also a pleasure to be in a session with the first paper, because when you put them together, you get a great perspective on some of the debates. And I won't continually refer back to the first paper, although obviously if you've been paying attention and not on your cell phone, you will see where some of the connections are. And you know, I'm as bad an offender as any of you. So, okay, great. Two key questions we're talking about this morning, obviously, are you know, how low and how long. The basic data we're familiar with. In this chart, I'm not only showing a short rate, which is the 3-month T-bill rate. We've been talking more about even a shorter rate, the federal funds rate, but also a 10-year real rate, and the trends are pretty clear in the data. These rates use a survey of professional forecasters' consensus expectations to get at inflation expectations. But sort of no matter how you dice it or slice it, you tend to get the same number. You know, short-term real rates are pretty negative right now. Why does this matter? Well, again, authors this morning have talked about this, most recently John a couple of seconds ago. You know, the perils of the zero lower bound. What is that? How does that constrain monetary policy? There are also implications for fiscal policy, though. It may be that with lower interest rates, there's more fiscal policy space. If fiscal policy is constrained by political factors, though, that's not going to help us very much. But in this ZLB and fiscal policy constrained environment, there may be higher trend deflation, and this can raise the perils of debt deflation, which can lead to a vicious cycle in which higher debts push demand lower, lead to even more deflation, and so on. And it's probably true that one of the factors that has made the recovery from the financial crisis and the debt overhang slower has been very, very low inflation, verging on deflation in some countries. And you know, Ken Rogoff has certainly pushed the idea of having a higher inflation target for that reason. You know, finally, if real interest rates and growth are linked in the way that theory says, and we've had a lot of discussion about that this morning, but let's just say that there's some connection for the sake of argument, then low real interest rates could foretell lower future growth. Just a partial list of what people have been saying. I won't run through this, except to plug some of the work at my new employer, the IMF, and my last employer, the Council of Economic Advisors. But the consensus is certainly that real interest rates are lower. How long, how permanent, this is a matter of more debate. The most recent thing that came across my desk was the last item, the Geneva report from CEPR, which is more on the optimistic side about all this, but says we cannot be certain about either the magnitude or the pace of a recovery in the neutral real rate. And I think nobody in this room would disagree with that assessment. What does this paper say? Well, first of all, this is a paper about the natural rate. And as Ken indicated, there are a zillion definitions out there of what we are talking about. But this one, very much in the spirit of the first paper, is about a very long-run natural rate, once all sort of transitory shocks have disappeared. Some people like to call this the equilibrium rate. You know, let's be clear on the concept. No evidence that this has moved back up even with the economy close to fully recovered from the Great Recession, and John showed that very nice chart. And I'll just note about that chart that if you look at it, there's actually what seems to be a permanent fall after the early 2000s recession. Nothing near as steep or as dramatic as what we saw after the GFC, but it's notable that there has really been these two seemingly permanent falls in their data. They also look at financial crises, and this was not talked about very much, but they find that after the typical financial crisis, rates actually recover after about 5 years. Not so this time. Episodes of the zero lower bound, they say, are likely to be more frequent and longer. Let me talk about their methodology. As John indicated, the big advantage of this methodology over univariate methods is it allows you to really put in more information about what's going on. For example, think about the Volcker disinflation. We saw a sharp rise in real interest rates, but we also saw a fall in inflation. This might tell you that the market interest rate is an overestimate of the natural rate because, inflation is falling at the same time. So their estimator builds this kind of information in, and I think this is a major advantage of this approach. I won't say too much about this because we only have a few minutes left, but they estimate an equation linking the natural real rate to the natural rate of growth, which is unobserved, but they estimate that. And they find that their coefficient, which corresponds to the inverse of what Anna called sigma, the intertemporal elasticity of substitution, is about 1.3, telling us that sigma is about 0.77, very much in line with the types of estimates economists believe. In their reading, growth is rather important, but it's less than half of what's going on, and they have this portmanteau variable z, which covers everything else. I just want to sort of show you something that Jim Stock calculated and that he generously shared with me, though, that even if you use a univariate approach, if you look at really long-term fluctuations, there is a case that growth and the real interest rate are correlated. Now, this is the long-term rate, and these calculations are for periodicities greater than or equal to 12 years. But there does seem to be this long-term correlation. And notably, it increases dramatically when you add in the global financial crisis and the aftermath. So this is something we should think about. Okay, very few minutes left, so let me talk about some conceptual issues. One that's been mentioned and that is featured in the first paper is the open economy framework. The global capital market has become more highly integrated over time, and in principle, if that's the case, the real interest rate should depend on global growth, not just the domestic U.S. rate of growth. You could put these factors into the IS and Phillips curves that are at the basis of this model, and you can think that an extension might even allow you to get at some very elusive concepts that we worry about a lot at the fund, the long-run current account balance, the long-run real exchange rate. That would be pretty interesting. But just illustrating the coherence here, this shows the interquartile range of short-term real interest rates for a large sample of countries. And you can see that they trend very closely together. The weighted average has been negative, has come up a little. But there's definitely something about the global environment that I think we ignore at our peril when we try to analyze U.S. real rates. Now, U.S. has also become a smaller fraction of the global economy, dramatically so over the past 15 years or so. So this is something I think we should take into account. Sorry, going the wrong way. A second issue I want to raise is the anchor for expectations. I don't want to go through these equations, but I would just mention that when we think about the relationship between inflation and the gap between the natural and the equilibrium real rate, there's also a term that involves long-run expectations. And looking back at the original LW paper from 2003, it wasn't totally obvious to me how this gets in the picture. Presumably, there's a Taylor rule in the background that's tying this down. But when we get to the zero lower bound, you're not operating with the Taylor rule. And the link between policy and expectations becomes much more loose. In fact, inflation expectations can easily become unanchored in the downward direction. If we look at Japan these days, there's a good case to be made that that's the case. Throughout the world, there's a lot of lowflation, if not deflation. The green line here is the number of countries in the world with inflation below 2%, and red is below 0, and you see these are creeping up. Now, maybe some of this is commodities, and particularly the price of oil. My gut suspicion is that something more sinister is going on, somehow, the model doesn't really quite come to grips with what is going on here. So this is something I'd like to know more about. A few other issues and questions, because I'm getting the eye here and I'm really out of time. Standard errors. If you look at the 2003 paper, there's a lot of variability in these standard errors, and I would have liked to see more on ranges. Now, LBJ is reported to have said to his economic advisor once, ranges are for cattle, give me a number. But, as economists, I think we want to know what the range of uncertainty is. Another big question, which is sort of at the heart of what we've been talking about this morning, and unfortunately, neither paper really brings forth hard evidence on this, is just the question of why have real rates fallen. There are a number of explanations. They're not disjoint, and a lot of them are global in scope. Low growth expectations. The IMF is forecasting, that doesn't mean it'll be true, but it's forecasting lower potential growth across the world. Okay, it's not just a US thing. US potential growth may or may not have fallen a lot. The Fed has certainly marked it down some, but across the world it is lower. We had a lot of commodity exporters riding on China's growth. With rapid growth, they have been more or less collapsing, and China itself is growing more slowly. Related, low aggregate demand, again, a global phenomenon. Without saying whether this low aggregate demand story is about global saving glut, a la Bernanke, and temporary or secular stagnation, a la Summers, and more permanent, no question aggregate demand is low. And then there's demographics. This looks kind of permanent to me. It is true China just relaxed its one-child policy, but we're in a global demographic transition. And there are a number of theoretical models suggesting that maybe this is a factor. And this list doesn't exhaust everything. There's safe assets and the shortage of safe assets. The Euro crisis wiped out a whole class of safe assets. One thing I don't think people have thought a lot about, or enough about, is just the nature of uncertainty. We had a global financial crisis when we thought we were in a great moderation. Now the world looks much riskier. There's climate change, there are superbugs, there is ISIS. The world looks much riskier. Shouldn't this impact interest rates and precautionary savings? I think the answer is yes, but our models don't really come to grips with this. So a lot is in that Z variable, and we need to unpack it.
Thank you. I think I'm going to change the program. So John and Maury, why don't you come up, and Thomas and Jan, why don't you come up as well, and we'll just integrate this to be a little more efficient. Well, I want to thank all of you for provocative presentations. I'm reminded of something that my colleague Louise Shaner has pointed out to me a number of times, that the list of things that economists don't really understand seems to be growing faster than the number of things that economists do understand, which is a little troubling. That was a joke, John. Don't look so serious.
I thought it was a full employment act for economists.
That's true. Not to mention think tanks. Maybe I could just start off with Thomas and John. Do you want to respond at all to what Maury had to say?
Sure. Just very briefly. First of all, thank you, Maury. Those are great comments. I agree with all of them. I think you highlighted some key issues. I actually pulled out my briefcase, a really nice recent IMF working paper that is trying to look at it from a global perspective, trying to unpack, I think is the word you used, the Z We started this project saying we don't really know what's going on there, so we want to be as agnostic and flexible. But there is a lot of work at the IMF, the Bank of England, and at the Federal Reserve as well, and other places who are trying to now dig into this and get better answers. And so I think that is important work. I will make one comment about the Kiley paper, which highlights, I think, really nicely how to bring in some other domestic factors to try to explain the low natural rate, including risk spreads and things like that. That makes complete sense to me. I think the hard thing is what we always run into is, are those permanent or are those transitory? So what Mike does, and it's a reasonable approach, is to say, well, I'm going to, as always, I'm going to make assumptions. I'm going to assume that these are transitory and these are permanent and estimate them that way. So he gets estimates, I believe, about 1 1/4 for the long-run natural rate using a framework like ours, but adding these other variables. But the question I have, and you see this in the IMF work too, is a lot of these supposedly transitory variables are still quite depressed or pushing the natural rate down. So in a way, you're answering the question by assuming that these things will go away. And I'm not convinced by that.
Thomas, do you want to add anything?
So I, first of all, would like to add my thanks. And I agree what John is saying is, I think we are not, we are not taking here a very dogmatic view, but it's certainly that the surprises in recent years have been all in one direction, namely that it's much more.
But it seems to me that Laubach and Williams keep alive the possibility that we are in a period of secular stagnation, of very low growth, and we should look at the symptom, low natural rate, as a symptom of that. And Jan, the paper that you did kind of questions that and say, no, I wouldn't worry about that so much. It's more likely to be temporary headwinds.
Yeah, with a lot of uncertainty, but I would say that my expectation would still be that we'll move back into positive territory if I had to put down a number personally, and I think the authors of the paper all have sort of slightly different views on that. I would put it somewhere in the 1 to 2% if I look out, say, 5 years or so. But I do think the more important conclusion, also from a policy perspective, is the uncertainty. And the takeaway that I think we all very much share, all of the authors of the paper, is that this is quite a strong reason for waiting until the economy sends a strong message that normalization is really appropriate. And
so, John, let me ask you about that. So you tell us that you're convinced that the natural rate of interest, inflation adjusted, is 0. You tell us that you see no signs that it's going up. You and Orphanides in the past have written that at a time when there are misperceptions of natural rates and we take account of private learning and stuff, that there should be a lot of inertia and there should be aggressive responses to inflation. In this case, we have inflation well below target. In light of all that, why would you want to raise rates in December?
So that is what we call a leading question.
Okay.
So I think that, first of all, let me be clear, and I think I'll let Thomas speak for himself here. I am not arguing that my best estimate, which is how Jan is, I think, answering the question, my best estimate is 0. I'm saying that we created this model for exactly this purpose 15 years ago, back when people actually thought the natural rate of interest was more or less a constant, and we were saying, well, it probably does change over time. And that model, as we've updated and continue to analyze it, is telling you it's 0. I think these other papers that I've been, there's a lot of papers on this now, including the papers by the IMF and Mike Kiley and others, argue that maybe the number is 1 or 1.5. So I see this as more of a warning, if you will, a red flag that there's something going on here that isn't really in our models. We really maybe don't understand as well as we think, and we should do, as Maurice said, dig down deeper and try to figure this out better, understand why that's so low. Now, in terms of monetary policy, I've written on this so many times. I was kidding Jan that I've got such a paper trail on this. I can't walk away from that, and I won't. I think the zero lower bound and uncertainty tells you to do a lower for longer policy. It tells you to have these kind of rules that respond either with inertia or difference rules, as Athanasius and I talked about in our 2002 Brookings paper. I think that the question then is this a judgmental assessment of how much uncertainty there is? I think we've been lower for longer for quite some time already relative to standard benchmarks. I'm not going to just choose a Taylor rule, but a lot of benchmarks for policy would have had us raise rates quite some time ago. I think we are, in my view, taking a lower for longer policy, we are, I believe, taking into account all of these different things. So the question then is, again, judging, all the economic outlook and judging the risk to that and all these factors, let's try to get this policy right. But this is definitely inside, this is kind of analysis is, I think, important for thinking about policy. Doesn't necessarily tell you, as some commentators said about this paper, that it's now obvious what we should do. I think it's an input into thinking about what we should do.
Maury, do you have a view on that?
Well, I'm not going to comment on Fed policy.
IMF loves talking about Fed policy these days.
I think we've said plenty on that, so everybody knows what the official position is.
Isn't it nice to be in an institution where you're encouraged to criticize the Fed instead of being at the CEA where you're not allowed to admit they exist?
It's been hard for me to get out of CEA mode and realize that, I can talk about monetary policy, I can talk about exchange rates, because we weren't able to discuss exchange rates either. That was the treasury.
We'll get to that later.
I can kind of say like anything I want.
I'm going to ask everybody for their estimate where the dollar is going to be 3 days from now.
Yeah. Right. I tend to actually, the CEA report, which I played some role in last year, took the view that the new normal is probably lower rates, and that's also reflected in the Anna mentioned the 2016 budget. That's something we worked on. But I tend to sort of find myself where Jan is. I'm not a stagnationist pessimist, really, about technological growth, about the possibility that there can be a recovery in world aggregate demand. So I think rates are low. I think they're going to be low for a while, but I don't really see it as a permanent state of affairs. There just are forces that are pushing toward more aggregate demand in the world. But it's going to be a while. I mean, most emerging markets are facing really severe headwinds right now, and China's adjustment to its rebalancing is having external effects that are far greater than we would have forecast. The Fed's normalization has got a lot of people subject to the jitters. I feel that when the Fed, makes its decision, it will be at a time when, the U.S. economy can deal with it and the world economy can deal with it. And, I think it's interesting that a lot of emerging market policymakers have been criticizing the Fed for not raising interest rates. So I think, for the Fed, it's going to be very important to, when they do raise rates, to be very transparent about what's going to affect the path going forward, how quickly that's likely to happen. I just don't think it's going to be the cataclysmic event that some are foretelling.
Jan? So would you take this analysis and say this is an argument for waiting even longer than we've waited so far?
I would, yeah. I mean, so I think it's if you look at the sort of implications of uncertainty around the equilibrium rate, for following an inertial Taylor rule that John talked about, that we looked at in our paper as well. I think that's an argument for waiting into 2016. I also think if you do bring in other factors, as in the Kiley paper, say the risk spread or more broadly financial conditions, that's also an argument for waiting longer, because it basically says the markets have already done some of the tightening that the Fed normally tries to achieve, and so you don't need to deliver as much on short-term interest rates because financial conditions are clearly tighter than they were 6 months ago. Now, some of that has reversed, so the conclusion is not quite as strong as it would have been in September, but I think it still pushes in that direction. So that would be where I would come out.
Brendan, can you give the microphone to Anil? Because when I changed the panel, I squeezed him off inadvertently, and I didn't mean to do that.
It's okay.
Can you stand up, Anil?
Yeah. So I guess there's one thing that's been nagging me, which is everybody took the 2% inflation target credibly. I checked. I think the 10-year note was 2.15 before John and Maurice spoke. Maybe they moved it, but it's kind of hard to reconcile that you've got this credible inflation target, you've got this very low 10-year note. Let's accept that the real rate is low. It's certainly uncertain, which means there should be a risk premium in there. And so I think counter to the arguments that Jan made, there is this question of how quickly that's going to revert to equilibrium. I don't think any of these guys would say 2.15 is a credible 10-year bond rate. So that's something we don't understand either, to add to your list. But there is a gross inconsistency amongst this constellation of prices.
So what does that lead you to do if you were the policy?
I would get off and see a little bit what it does. I mean, I think the sooner you can put two-way risk back into markets, the more likely we're going to get there. And the question will be whether it has to overshoot or not. But to me, that's an argument for at least changing a bit.
Thomas, unless you want to comment on current Fed policy, I wanted to ask you a different question. So a number of people have mentioned that when you think about the world going forward, and you really want to decompose what's going on with the natural rate, how much of it is influenced by a depressing view on productivity, and how much is a consequence of demographics, which, as Luis said, are not only an American phenomenon? How do you even begin to think about this, and how do you tease out the two components?
So I'd say we tried in our approach to control separately for that one factor. I think we are keenly aware of the uncertainty around our estimate. I think it would be fascinating to try and extend this type of analysis to longer samples, more countries, as the other paper has started to do, to see whether we find some correlations over longer horizons. One issue that we briefly touch on in our paper is that we think about, is there any evidence that these real rates stay consistently low for a long period of time after financial crisis? In our first pass, we are actually not able to tease that out. That said, it's conceivable that this financial crisis, as Ben Bernanke has argued, has been much more severe than anything that we've seen before in this realm, and therefore may have had a much longer imprint. I just, in general, point out, I mean, we as economists need to be suitably humble whenever we talk about the long run. Is it persistent or is it permanent? At some point, we are just missing the data to make confident statement about, is this going to last 5, 10, or 20 years? It's just very difficult for us to predict because we don't have that many observations over the long run.
Right, but it's important to know whether this is a passing phenomenon or a signal of something really serious going forward.
I don't think it's as important right now that we answer this question definitively, and here's why. There's a lot of argument, you could say, between our two papers, is it growth or is it not? But there's actually a lot of consistency, I believe, and but please correct me if you disagree, across the literature that at least the effective shorter run natural rate of interest is very low right now. You can look at DSG models, you can look at our own analysis, you can look at Kiley and a lot of other papers. So at least for the next couple years, I think there's a pretty consistent story that the headwinds are very significant, holding back growth, and the natural rate of interest is lower than normal. I think that's actually a common theme. Then the question is, will that be true 7 years from now? And to what extent is that true? I mean, we're going to have to just collect more data, get more evidence, and actually do more research on this. But in terms of the policy implications, I think there isn't a lot of, there isn't really a divide between people saying it's 2.5 and saying, sticking with that. I mean, pretty much everybody, I would say, Jan, you would agree that at least over the next couple of years, the effective short-run natural rate is depressed because of headwinds. Yeah. Right.
But in terms of fiscal policy, Maury, what does that imply that fiscal policy around the world ought to be now?
I actually put a fair amount of stock in Larry Summers' argument that, if you think about infrastructure investments, which in many countries that have a high marginal product, this is a really good time to make them. From the national perspective, you borrow at zero and you invest in something that's productive. That's a net gain. What prevents countries from doing that? Well, I would take the position that it's mostly the accounting framework they use for thinking about public debt. It increases the gross public debt. But if you take a look at the consolidated public sector, it's a winner. So, that kind of thing shouldn't prevent governments from doing economically beneficial investments. But unfortunately, the way fiscal accounting tends to work, it's thrown up as a political barrier. From the economist standpoint, it's kind of a no-brainer.
You know, I agree with this point. I think that, you know, we're sitting there, monetary policy can't solve structural problems, it can't solve long-term problems. We have to focus on what we can control, nominal anchor and short-run counter-cyclical policy. But this is an area where if the natural rate of interest even is 1%, we don't have to go down to zero, the implications for monetary policy, I think, are pretty significant. And, you know, if we could come up with a better fiscal policy, better, you know, find a way to have the economy grow faster or have a stronger natural rate of interest, then that takes the pressure off us to try to, come up with other ways to do it, like through a large balance sheet or having a higher inflation target. But it also means that we don't have to turn to quantitative easing and other policies as much. So this is, I think, an incredibly important issue in terms of for monetary policy, and obviously not just the U.S. I mean, this is true around.
Let me ask you one final question, John, before we turn to the audience. As you know, there's this bill pending in Congress that would write the Taylor rule into law and require the Fed to explain when it deviates from it. And the Taylor rule, which is a kind of a rule of thumb or a formula for the Fed setting interest rates, relies on knowing what the equilibrium rate is. So given what you know about what you've learned about the natural rate, do you think it's a good idea or a bad idea for this legislation to require the Fed to measure itself against the Taylor rule?
Another leading question from David West.
It wasn't leading. It was.
Yeah, this is a very bad idea. Obviously, I found the Taylor rule very useful, and all the variants of the Taylor rule, the thousands of Taylor rules. Again, let 1,000 Taylor rules do. Incredibly useful. I've done a lot of research on that. We analyze that. We think about that. It's really helpful to think about monetary policy strategy. Think about how to zero lower bound issues, a lot of different issues. But in terms of this, even just on this narrow issue of the natural rate of interest, I think the two things I've learned from both my experience but also research is the natural rate of interest is not a constant. I think everyone agreed on that. We don't know what it is, but it's probably not constant over decades. So just legislating that it's 2 would be very negative. And the second is, one of the things that Athanasius and I learned is that when you don't understand the natural rate, you don't want to be following the Taylor rule. The standard Taylor rule performs poorly in an environment where you're very uncertain about the natural rate of interest and, honestly, the natural rate of unemployment, which we haven't talked about, but there's just as much uncertainty about that concept as this one. And so the Taylor rule is a great benchmark. It's a great thing to keep in mind. But clearly, in a real-world environment, even on just one dimension, it is not up to the task for thinking seriously about implementing monetary policy on that. And that's not even getting to the other issues around the Taylor rule.
Anna, do you want to make a comment or ask a question? No? Louise?
No.
All right. Let me start with, Ken or Ethan, any of the authors want to weigh in?
Yeah, Jim Hamilton, again,
Jim,
UCSD.
can you stand up? It's better for the cameras.
Yeah, I just wanted to emphasize one very important common ground between the two papers, which is a lot of theoretical models assume that R star is constant. And we found a lot of evidence that it's not constant. And an important implication of that is if it's changed before, it can change again in the future. If your Z is a random walk, your current forecast might be its current level, but it could vary quite a bit from where it is now. That's kind of what we're talking about this uncertainty issue.
Mm-hmm. Good point. There's a question there on the aisle, and then maybe you can give the guy with the blue shirt, if you stand up, and Brendan, why don't you give the mic to, okay.
Thank you. Larry Checo. I'd like to simplify this just a little bit, but if NRI is so determined by growth, I'm surprised nobody has talked about income inequality in this conversation, and the fact that, perhaps the 1% is sopping up so much of the money out there that if you really want growth, people aren't going to buy stuff unless they have money. And it's obvious. I don't think I have to explain it any more than that.
So I think when Ken put up his list of 12 things, we're now up to 15. What role does inequality rising?
Well, it's actually broader. I mean, and this is something Larry Summers has talked about, and that's the falling labor share. A lot of these kind of secular changes in income distribution, labor share, these do feed through potentially into that simple IS curve that I talked about and can be shifters. So again, that list is very long. We don't have good quantitative evidence about how big the effects of those are, but I agree that there's a lot of things that shift both the IS curve and potential output curve.
Krishna?
You're not going to ask when we're going to raise rates, are you?
I already did that for you. I got that out of the way.
They won't stop him.
David already did that.
Krishna has a way of asking long questions. You have a long time to think about that.
I'll keep it short today. For John and Thomas, how does your framework help you to think about the role of the dollar? Is this something that could keep the short-run natural rate below a longer-run equilibrium? How would you think about potential longer-run implications for a steady state?
Specifically about the value of the dollar today? Or?
Well, the developments in the foreign exchange.
Yeah, okay. Yeah. So, you know, I'll tell you that this was not the only project I have worked on measuring the equilibrium real interest rate at the Fed. One of the things, working off Antonio Bonfim, one of my former colleagues' work, using the old MPS model, I worked on projects with using the Furbis model, and what you try to do there is you basically try to unpack, if you will, all of the long-run factors that are on the right side, you know, that are driving aggregate supply and aggregate demand. And obviously, the endogenous movements, the exchange rate, that are part of the business cycle. That's all business cycle fluctuations. But try to pin down term premium, equity premium, sovereign risk premium, all those. And so we've done that kind of analysis, and clearly that would tell you that all else equal, a stronger dollar would depress, again, all else equal, and thinking about this as a long-run phenomenon, would depress aggregate demand somehow. The issue with there is you end up with 40 factors, I think, that push around the natural rate. And of course, all of them are subject to a great deal of uncertainty. And it was really hard doing that method of aggregating lots of different things to know, kind of how much uncertainty and kind of robustness there was around that. But that's the way I kind of tend to think about it. The thing that you have to be very careful about looking at asset prices is asset prices, like everything, are endogenous variables. And so if the Fed is, in a cyclical sense, if the Fed is moving one way or expected to move one way, and the ECB moves another way, that's going to move these variables. The question we want to know is, 5 to 10 years from now, where will these things land?
Anybody else want to weigh in on that?
Yeah, I mean, the other aspect of your question, and maybe what you're also getting at, is not the dollar's level, but the role of the dollar in the international system. So I don't want to speak for Ben, who's not here, but he would probably say something like, if you look at that period from 2000 to 2007, where real rates don't really come back, part of what was going on was central banks in the emerging world accumulating dollar assets, pushing down dollar yields. How important is that empirically? There's some evidence that it explains, 50 to 70 basis points. But again, that's an area that is uncertain. It probably doesn't explain as much of what's been going on since the global financial crisis.
I would just say the dollar, or more broadly, financial conditions are important for monetary policy. So when financial conditions move, then that can have implications for monetary policy that go in the other direction. And once again, I think that's one potential reason to wait a little longer in terms of the liftoff.
Peter Hooper, can you stand up?
Yeah, and what are the reasons to go earlier, just in case I...
Peter, stand up so the mic can... Sorry, what'd you say?
Tell me a reason that we're supposed to go earlier.
I think
I wanted some balance.
Yeah, I think that labor market slack has diminished a lot, and U6 continues to come down quickly.
Peter.
Just a comment and a question. John, you said at the beginning that this was a paper about Z, not about growth, and that comes through very clearly in your chart 6. You're actually fairly optimistic, I think, about where potential growth is currently, about 2.25%.
I agree.
Case could be made, it could be considerably lower. But my question is, and that, by the way, drives, if Z were not a factor, your neutral rate would be close to 3% now, given your coefficient, I think. My question is, take 1.3 as a coefficient on potential growth?
Right.
Okay. My question is, in determining the movement in the neutral rate of time, it's basically the slope of the IS curve. To what extent is the model you're using one that could have changed over time? Has the interest sensitivity,
Sure.
decline, this sort of thing?
Yeah. So, Peter, that's a great question. We are estimating them all from 1961 through 2015. The U.S. economy has changed in many respects. And I think, was it Maury, you brought up the issue of anchored inflation expectations or inflation expectations. So one thing we've played around with, you know, we spent a lot of time in the lab, in my, quote, free time, on the weekends, trying different specifications around the inflation process, around other aspects of the specification. And we found that, again, the point estimates change. There's no question that as you re-specify them all, you get slightly different point estimates. But the thing that comes out every single time is this point that Maury, actually, thank you, made, because it's in the paper, is there were two waves of declines of the natural rate. One between 1990 and 2007, which was modest or moderate decline, and then this plummeting after. And that comes through pretty much any attempt we do on the model. I will say something about what you just said about that if it wasn't for Z, R star would be 3. That's not actually true, because we did run that experiment, and it's kind of in with this Fleischman-Roberts thing, is as long as you allow us to estimate that coefficient of C, the data scream that the natural rate is low today. That's what the data want. They want it any way you can get it. So when I get rid of Z, what happens is the coefficient on G star goes up to 2, R star still comes down, because it's just going to try to, the data is trying to get it in there. And with the slowdown in productivity, potential growth, that's the way it happens. I will tell you, there's a really nice paper from the Richmond Fed, Thomas Laubach and forget the...
Mattes, I think.
Yes,
yeah.
Mattes. And what they do is they do a stochastic volatility, time-varying parameter kind of model, the fanciest Bayesian estimation with everything moving around at once. And they estimate that model, and they end up with estimates of the current natural rate of interest, which are not 0. I think it's about a half percentage point around there. It's a little bit above ours, but it's very consistent with ours over the last 35 years. So that gives me a little bit, we mentioned this in the paper, a little bit of confidence that maybe our model is wrong. I mean, any model you write down is wrong. But when you do it all these different ways, you kind of find the same patterns.
Does any model predict that the rate will rise again?
If you assume.
If you assume it, okay. Jason Cummins in the back.
Thank you, Jason Cummins.
Oh,
Normally a questioner asks a question, but I'm actually going to answer a question that was posed, which will present a little bit of discussion. So David's first question was about why are rates, what's the rationale for raising rates if the paper has R star estimates of 0? I would have answered, if I were sitting in John's spot, perhaps he's constrained in some way, I would have pointed out R star is 0 in that model, but the output gap is also 0 in that model. So what should rates be in that framework? Well, they should be at equilibrium, because the model basically is in equilibrium. Real rates right now are not 0. They're negative. If you balance sheet adjust them, given that there's a large balance sheet, they'd be even more negative. So rates right now in that model, if you spit out a rates path, actually has nominal rates going up a bit, higher than they are here. So I would have answered the question a bit differently by saying that yes, rates are low in that framework, but they're above even where they are now with a natural interest rate of 0 because they have a 0 output gap.
So I agree with most of what you said. I think that if you think about this as a Taylor rule, it would tell you the intercept of the Taylor rule is 0. If core inflation's running at 1.3, so you would be at 1.3 for a funds rate if you're kind of starting point. Then there's the coefficients on the inflation and output gap, and I agree the output gap term probably is relatively small. But the inflation term, we are below 2% inflation. So the reason I didn't want to go into that is it really depends on your views on also what's your response to inflation and all that. But your basic point, I think, is valid. It would tell you that the equilibrium nominal funds rate is, even our estimates would tell you it's 2. And assuming we were in equilibrium, we wouldn't stay at 0 interest rates forever.
Maury?
Yeah, I mean, the great danger is that we're at the 0 bound. We're not in a standard Taylor rule situation, and inflation has not risen to its target level. So what if you raise the interest rate, the nominal interest rate, and the economy worsens and you get more deflation and the real interest rate goes up? I think that's sort of the nightmare scenario that people worry about when they say the Fed, there are risks, the Fed should wait.
Mr. Brown?
Thank you. Isn't the real problem growth? And the way you get growth is by moving money, velocity, that it's wonderful that Congress has come up with a budget that plans to spend all of 1 month's worth of quantitative easing. We've had a real problem where we have paper and a lot of money caught up in paper, financial instruments. The financial crisis wiped out some unknown amount of money, but the real issue is getting money out of the banks where it does nothing and getting it into the economy where it might trigger some growth. Corporations sitting on mountains of cash don't go to the banks looking for loans. They don't need it. But if they can't get that cash, if they don't have ideas for getting the cash into the economy where there might be growth, maybe that's a role for taxation.
I think there's agreement here that Thomas, So there's agreement that fiscal policy could be more constructive. Go ahead.
So one thought that's triggered is, of course, what was observed earlier. Namely, we may be in a period where actually we have an unusually high degree of risk aversion that may last for a long, long time. And the factors that you mentioned may be a manifestation of that very high degree of risk aversion, that maybe people felt they got burned very badly in ways that they had never imagined before during the financial crisis. And this is just leaving a very long-lasting imprint on various types of economic behavior.
So, I actually do believe that, those kind of factors are affecting aggregate demand, if I can stick to Econ 101 kind of ideas here. I think they're affecting aggregate supply, too, for these reasons. Risk-taking is less, investment. I live near Silicon Valley, so I can't actually believe this since everyone's inventing a new world every week. But, there may be depressing investment, innovation, and things and lowering potential output. The problem is, to the extent that we've tried very hard through monetary policy to create greater risk-taking, to basically reduce, interest rates and cost of capital. I think, we can debate whether monetary policy has been optimal or not, but there's no question that we've done enormous measures for accommodation, $4.5 trillion balance sheet, low interest rates for 7 years. So to me, some of these things are outside the control of monetary policy. The risk appetite, the firms sitting on cash, as opposed to investing in productive capacity and increasing the aggregate supply. I think the fact is that, plus or minus 1%, we're close to, output gaps are relatively small today. So it's not just demand. If you're really thinking about why isn't the economy growing faster, we could say that some of it's demand, but I think a lot of it is actually the supply side of the economy is just not growing very rapidly, and that is the demographics and productivity.
Neil, do you want to take a shot? No? Okay, with that, please join me in thanking all our panelists and presenters. As I mentioned, we'll be discussing how the Treasury borrows on November 10th at the University of Chicago. We welcome your involvement in that. My colleagues at Brookings would appreciate it if you look to your feet and pick up the papers and coffee cups. They're there, and put them in the recycling in the back. Thank you very much.